Good evening, Professor. My name is Issac Wils, and my student ID is B205269. I'm here to talk about I'm here to talk about the importance of understanding the randomness of a stock price change, realizing that the stock market is always unpredictable, and that's a key for the stock market for making a successful investment choices. So it helps us to avoid thinking that we can predict everything and encourages us to focus on long term. And this is important for building strong, sturdy investment plans. And knowing the market's unpredictability also stops us from making decisions based on emotions, unless let us adjust making markets constant changes. So it it helps us to understand the unpredictability of the stock market. So as we discussed today, let's agree that understanding the unpredictability isn't a problem, but actually a smart move. It gives us an edge, helping us to make wise decisions in the tricky world of stock markets. Moving on to the challenges having in randomness with the stock market. Many investors believe that analyzing stock markets can lead profitable outcomes. Let's examine this in brief. This might challenge the idea of random stock price movements. Let us think about many people believing that they can predict stock price might cause a create a problem. If a lot of people follow this belief, it can make the stock price seems less random than they really are. In reality, stock prices often move in a way that they are hard to be predict. But if everyone thinks that they can predict it, their actions, their actions altogether actually influence the price. And this is important to be like very careful about assuming all these outcomes, that we can always forecast stock markets movements, because a market can be more unpredictable can than what we think. So the reason why do I say so? It's called domino effect. Picture a bunch of people like together playing with dominoes. Now many of them start copying each other, doing the same thing. It can create a whole room of dominoes fall like into a pattern. Even though each person thinks that they're doing what the others are doing, but it might look like their plan or their decisions or making a plan would like an order. Everything to it would look like a same pattern. So in the stock market, it's very similar, like the domino effect. When a lot of investors follow the same pattern, it may the stock I mean it may make some stock prices move in a way that it seems predictable, but in reality, it's just everyone acting together. This is why it can be harmful for the stock market if this phenomenon is followed. And the behavioral aspects of the stock market. So when we talk the behavioral aspect of the stock market, we're delving into how the people act and feel and how they influence the market. Sometimes the way the stock market moves isn't just because of the clear or logical reasons or the company's performance. No, people's actions and feelings, their excitements or the worriness or the desperation, they play a big role. It is when everyone is really excited about a new technology. Yeah, there are like a lot of examples in the market right now. And even if the company behind it is making much more money, yet the stock prices might still go up. I mean, yeah, if they're not making enough, the stock markets still go up. This is the perfect example of the domino effect that I just explained, like going with the flow. So what the investors feel and think they can have a strong impact on the stock prices. And this can make the market seem less random than it truly is. It is really important for us to understand this human side to the market makes smarter decisions like the unpredictedness. So as a conclusion, I would say I would like to remind that this topic emerges from the random walk theory, which acts as a foundational concept in financial theory. It mainly suggests that the stock prices follow a randomness and unpredictable path. This idea is important implications for investment, like the strategies, market efficiency, and the debate between the technical and the fundamental analysis of the world of finance. So this just to make it clear, the grasping the randomness, the act of randomness in the market is like having a compass in the world of investing. Yeah, exactly like the compass. It is very crucial for making smarter choices by balancing our approach and looking at the both the technical stuff, like the way how the data shows, how the looking at the data, what we have from the previous functioning of the company and the basic facts about the company. We built a strong base for handling the twists and turns in the market. Think of it is like a of the combination of the best of two worlds. So in order to conclude, I would like to say that the fact of randomness on the stock market is a must known thing to anyone navigating the tricky waters of the financial world. And it is very much important not to just to follow the path that everyone follows. Always have to be more unpredictable, to be like swimming in the same path. And that's a wrap up for the day. Thank you. Thank you so much, Professor.